On behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to a very special St. Patrick's Day buy, hold, sell. I am your trader, Todd Schoenberger. That's right, and I'm joined by my friend and co-host and the guy who is been celebrating all weekend, Toby Smith out in Scottsdale, Arizona. Toby, St. Patrick's Day, luck of the Irish, Jeff Hirsch called it. He said markets rally on St. Patrick's Day, especially when it falls on a Monday. We had a big run up on Friday, big run up today. Have we seen the bottom? Is it in the rearview mirror?
Well, I love Jeff, and I love St. Patty's Day. I can't quite make the leap that, especially on a Monday, because the hangover usually is on Tuesday, and that's where the sellers don't sell, but maybe they're assuming that. Todd, we're just in that weird situation that, first off, everybody used the word that investors had grown complacent. Well, hell yes, you grew complacent. If you own 7 stocks, your average return is 84% a year for the last 24 months. That is not normal. The stock market goes up about 8% a year, okay? Or 10% in the, modern if you take away the COVID. So we're so far ahead of us. I love every metaphor, but particularly over your skis. I still love that. Only people who ski understand what the F being over your skis means, But the market was seriously over its skis. Corrections happened, again, to use Jeff's Hirsch's data and Sam Stovall, for crying out loud. And by the way, if you didn't see our last interview with Sam Stovall, you got to see it. Because he had more data than a freaking, IBM computer in his head. I don't know where he puts it. That supports this. Yeah. So anyway, I here's where we are. We're number one. It's not that MAG is going away, SEM's going away. It's just that it's a source of funds, and it hadn't been a source of funds for 2.5 years, really, since April of 2024. So we're coming up right now to the second year. 23, April 23. So when you become the source of funds to a portfolio manager like me, you have been taking profits hopefully along the way. And now that they're mostly fully valued and the hysteria is gone, now you look to other secular growth areas. And we got a bunch now, and they're much cheaper. Some of them even play heaven forfend a dividend. And if your expectation is that I want to beat 10% the average per year, then I can beat that easily with stocks and not have to worry about what Jensen Huang's going to say about something or any earnings, because we're now just in 3 weeks we'll be in earnings season again. So for instance, Todd, the European defense stocks are hard to buy because they trade, on the bourse, so they trade on the German exchange. But there's ETFs. I'm just looking at my favorite one here. My favorite one is WASP, W-A-S-P, but it doesn't trade over here. I just like that because it's Irish Day, us WASPs.
Yes.
But the XAR and the PPA are funds that own a significant amount of the key parts of the European defense system. Because as we all know now, the president of the United States has essentially destroyed the post-World War II NATO-US armament proposition that's been around, since my dad was a PT Boat 108 captain back in the day. Yeah. So, I'm not going to argue whether it's good or bad, but what it is it's good for those defense companies. Germany's going to. They said 1.2 trillion. Now it looks like about 2.5 trillion that they're going to put in. France is at 800 billion. UK doesn't consider themselves Europe, obviously, but they're all part of that NATO bloc, etc. So we're buying the heck out of the European defense players, and the easiest way to do is through the stocks, the ETFs I talked about, and they haven't gone anywhere for 5 years. I mean, they have been dead as a doornail. Dead as my liver after tonight.
So you're going with the assumption, though, because we are now, like Jim Bianco said on Buy, Hold, Sell a few weeks ago, for 80 years, the United States has been protecting the European country. So now, because we're now punting that responsibility, the defense responsibility back onto these countries, you're suggesting that now is the time to start looking at some of these
No,
defense
it's not
contractors.
start looking, it's to start buying.
Start buying. There you
We've
go.
been buying them since the Zelensky fiasco.
Okay.
They are very, I mean, you compare F-35, which is made by Lockheed. Lockheed sells at about a 25 to 30 times earnings, depending how you consider their earnings. You could buy the biggest missile company in the EU for an 8 PE, and the $1.5 trillion just from Germany means they're not buying a whole bunch of F-35s. They got enough F-35s, but what they need is missiles. What they need is hypersonic missiles and Reichstag, blah blah blah. I can't, you got the German thing down. I'm Irish. I can't do all that accent. But these, they are going to be in a secular, meaning long cycle, not short cycle, growth in earnings and in sales, etc. And then there's all the services that's involved in it, because they're not just selling the missiles; they're missile systems. So they get ongoing revenues from repair and updates and all the then all the computer stuff. So we've been making nothing but money with those things. Secondarily, look at China. China's stocks have been on their back for 4 years, for a variety of reasons, starting with the fact that they had this huge crisis of overbuilding apartments. The last time I was in China, I spent a day outside of Shanghai just to see these built apartments that were completely empty, except for windows, Todd. Evidently, they didn't have enough money to put the windows in.
Yeah.
8,000 condominiums / apartments, because you own them. In China, there is no such thing as a mortgage. You actually have cash, and then you go and you buy your apartment.
Okay.
They're uninhabitable. They have to be torn down because no fixable. Multiply that by like $2.5 trillion of essentially wasted money. And that's why their economy sucks so bad, and why the earnings were so bad. Although the Mutai, the public company that makes the best freaking firewall I've ever had in China, that Mutai, they're doing quite well.
Okay, it's amazing. It's amazing.
Yeah.
So let's turn the focus back domestically, though, here in the U.S. Now, what are we looking at? Because you still have the Fed meeting. It's going to be the critical event of the week that's clearly going to move the markets north or south. We just have to figure it out once we hear what the decision is, which we all know is going to be no change. But then the press conference afterwards is going to be more influential for traders. But with that, or do you see, because Sam Stovall was actually today, he was on the show Friday on buy, hold, sell, but just today he was in the press saying we still have another 4% drop in the S&P 500. I mean, that's incredible. So is this a sucker's game right now that people are jumping in, or would you recommend that people maybe stay on the sidelines and just wait and see how things play out?
Yeah, Todd, first off, you have to distinguish between a trader and an investor. Okay, so let's talk about investors. When you get a correction, which is very healthy, it's healthy because all the people who panic sold, all that cash is now available, to come back in, right? But you take 3 bites. We, at my mutual fund and my hedge fund, at our money management accounts, when we go through a correction and we have a list of stocks that we're secular growth stock people, or we're also bond people with our high income stuff, you take 3 bites. And you buy on red days. You don't buy on green days. If you buy on red days, then you're an investor. And you're also not a trader. And you're also smarter than the folks who, push it all in on one day and on a green day. Now, what you do in this, because remember, these things chop around, they call it chop around for a reason. There's a lot of mechanics in the market, stock market, Todd, as you know. But one of the mechanics is we're getting to the end of the first quarter. So there will be a rebalance in all these ETFs that are market cap weighted. And so the big cap guys that have come down, you could make a strong case that on a market cap basis, they're going to get more cash than they normally would, which would raise prices, etc. The losers get sold, and then people, if they're good stocks, then they get bought like the day after the end of the quarter. So we're in that period where you have to make a decision. Are we going to a 20%, in other words, a real bear market? Well, every bear market, and I've been talking about this on the show for the last couple of weeks, but every bear market in the recent history, let's call it from the 1980s, was rescued by the Fed or the federal government. And in the pandemic's case, it was both. Since the federal government is causing this correction, that's the wild card.
Okay.
And the wild card is, okay, if the Federal Reserve is not going to do anything on Wednesday, and the federal government is making these giant cuts, and then April 2nd the tariffs go up. I'm not putting all my chips on before April 2nd, but I'd like to see April 2nd happen negatively, because then I would be a buyer again of what's been left behind. U.S. healthcare hadn't done anything in 2 years, because for a variety of reasons, but it was mostly the elections and so on and so forth. But United Health, you can buy 8 PE, secular growth, pays a dividend, buys stock back. Okay, what I'm saying is, for the last since we started doing the show in April of 23, my company and my research business and everything else, we have been, the AI tech stack, boom, 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 and had ridiculous results, 200% a year gains for 2 years in a row. So that's 40 years of gains, right? That doesn't happen. About every 20 years, that happens. So now that we're essentially digesting all of that, which is necessary, because my favorite other truism: trees don't grow to the sky, right? I don't know where that one came on Wall Street either, but they do grow to the sky. But if they get too high, they fall over in the wind. And what we got was a wind in the form of tariffs, in form of also the expectation. Because remember, the expectations were, woohoo, we're going to get deregulation, we're going to get lower interest rates, we're going to get lower inflation, and maybe a few tariffs. And then it became, what? We're getting historically high tariffs, and they're not just a threat, they're not a bargaining tool.
Yeah.
They're actually going to be employed. So that was the shock, and it's still not over. And I'm sure April 2nd, I don't know, should we make a bet on whether the get instituted on April 2nd, or it's a bargaining chip and we come to a conclusion? What do you think?
Well, I'm going to go with the bargaining chip. I do believe that this is part of the art of the deal, the part of the negotiation. And that's how I'm going to play it. But yes, you are right. For Wall Street traders, they're going to be all over the place, and we're going to be in this up and down pattern until April 2nd.
I'll take.
But what do you think, Toby?
Well,
do you see?
I mean, remember, in the first year of Trump 1.0, he put tariffs on. Market didn't like it, but they were small. I mean, on a relative, but this wasn't like 25% on lumber coming from Canada, et cetera. By the way, my Canadian wife and friends, we had a call last night with some of our Canadian friends. I cannot use the words that they've been using. Of course, I do use them on the show, but they are pissed off, and they are canceling trips to the United States. The one group had to go down to New York. I know you don't care, but these are affluent people that were like coming down for a Porsche driving cruise through somewhere, at $8,000 a head, that times 100 people, and it's all canceled. So that's like one little, iota of this. But again, I would bet the other way. Because remember, there was a bargaining chip, but there's been no response, because the number of 20% or 40%. I mean, my family's in the wine business. Every 40% tariff on wine and a bourbon, for crying out loud.
Right.
The Canadians are the nicest people in the world, and we pissed them off.
We're pissed them off. That's for sure.
I don't think they're going to come back and say, "Oh, all right, wait a minute." All right, excuse me, wrong accent. They're going to say, and this threat is going to go through because Trump wants to punish them because they didn't acquiesce to his demands. That's my bet. So we have a gentleman's bet here.
Okay.
And you can decide what the bet amount is.
Okay.
But again, in the meantime, if I'm an investor, the only, the risk here is that we get tipped into a recession. We're not just in the soft landing where, growth comes down, but inflation comes down too. So they offset each other, and earnings are stable, and analysts can project out 3 months, 6 months, 12 months, because you know what the playing field is. The problem now is really no one knows what the playing field is. There's been other than calling Mexico and saying, okay, I'll cut the 40% down to 20% tariffs. That wasn't a negotiating. They went from 40 to 20% tariffs to a trade partner of Mexico in the North American Trade Association. That's illegal as far as everyone I know who's in that business. That was what NAFTA was about.
Yeah.
So I don't, I think there's going to be a crash and burn a lot of these things, but the American economy, as you know, I say 12 times every week, the top 25% of the households are 90% today of discretionary spending. So that's what we watch the most, because at the margin, it's okay, honey, we're not going to go to Germany this year. Hey, look at what Delta came out and said that personal travel and obviously governmental travel down the tubes. The cruise lines is the other one we follow pretty closely. They're booked out for 9 months. I mean, they're booked. So, but if they start getting cancellations, that's another sign that the higher end consumer, which makes all the difference in our GDP, consumer GDP, is pulling back. So that's where we're looking. I'm not afraid yet. The 200-day moving average, simple moving average on charting, we went right through 50. We went right down through 100. The QQQs got right to the 200-day, and they held. And that's remember, 75% of the trades every day are algorithmic trades, the computers. And when you stop at those key technicals, there you go. So it's the bots and the boobs are running this show here. So let's see.
Well, we'll see. We definitely will see. Well, we're going to leave it right there, Toby, because we just want to get this out, have a quick snippet about what is happening with the markets right now, and I'm sure we'll do it again later on this week. So on behalf of Tobin Smith, I am Todd Schoenberger. Have a wonderful St. Patrick's Day. Be safe. Have fun. Celebrate.
That's right, lad.
Yes, there you go. And we'll catch you next time. Take care.
Buy, hold, sell, brought to you by CrossCheck Management.
I want you to smash that like button.